Hi again. Uh, I'm happy to see you all. And I see some people that are coming for the first time. So we are the Global Value Investing Club. We operate in multiple cities. The most active, meetups are here in London and Malta. You can visit cityfalcon.ai meetup and you can see the past presentations. All the presentations are there. And also, if you go on YouTube on our channels, City Falcon, at City Falcon, the videos we record the videos so you can see past presentations. And also at the same page, City Falcon slash meetup, you may go and see all the companies that they have been presented here and their performance. So we will discuss about 2023, which was a good year for people who link their their performance with the price performance. Some value investors are not so crazy about it. And I think also I don't, you know, assess myself for my performance for 1 year. Uh, but it's a lesson because the previous year I think we were around -20. It's a lesson that you may have on average a 10% even if you follow the index, but it's not a smooth ride. Uh, Now I I want to open the floor to you. So do you have any experiences to share or lessons that you learned? Because every year, if we can become 5-10% better in a decade, we can. So I don't know if this year was an opportunity for you to learn something, or it was something. I mean, I guess it's easier for people that they had some good performance. Who of you think that you have outperformed if you want to share? So everyone has underperformed. Yes, that's why we like. That's not very good for the club. We are value people, so we underperform in those. Okay, I can share maybe a lesson that I learned this year. So I noticed that my bigger positions generally do not work well. Okay, see, for example, I had also a failure this year in the UK. Safe style went bust. It was not a big position, but I see that some medium positions, if I take the average, I have some two buggers. I have stocks that they get 70%, 50%, and I lose money. When I lose money, I lose more. So for me, it was to learn this lesson that probably diversifying more. That was something that I relearned this year. Anybody else that want to share their stories? I mean, yeah, you can come here. I mean, because we have this microphone this time, so take care because it's short. It's short.
Hi. So you mentioned SafeStar. So I had a total loss on SafeStar too. I think it was 0.8% of my portfolio. So if I'd been less diversified, I wouldn't have held any. Right. So that's the main point there. So I think I'm slightly over diversified, I would say. I should have focused on my best positions, not just the best positions that turned out after the event, but the ones that I was most convinced about, like 30, for an example. So that was a counterpoint.
Yeah, I mean, there are many, uh, you know, uh, advantages and disadvantages of being diversified or over diversified. But for me, it has worked. It seems that it works better when I'm diversified. Uh, and probably even 10% or 20% goes bust, it seems that the rest makes up for it. So it doesn't mean that I'm not strict. I'm really strict with choosing, but that's how I have seen it works, and I see it again and again. Yeah, a valid point.
Yeah, just about 2023. I think a big one for me was Meta, because that was a bit of a weird one where everyone hated it for a very long time. It went down a lot, so I was already on quite a large position when it went down. And it was quite difficult, but I didn't sold. And I tried to average down, but I was already with a quite big position in there. And now recently it just went crazy. So I guess also the thing is also what to do with in 2024 with now what's called the Magnificent Seven. I think is also quite interesting topic to go through because um, like yeah, most of those stocks are now overvalued, but even being overvalued, Meta and Google seem to be the one that are the less overvalued in the group. So I would be interested to hear if anyone has an opinion about that and how they plan to put those companies in their portfolio.
Any thoughts on those comments, Alex? Yeah.
I think it's,
Just come here because we have the microphone
I
here.
don't know about those companies, but I own.
Yeah. Go and share your.
Yeah, so one thing I learned was position sizing. So if I like a position, I make it quite a big position. But then if it goes down, I would like to add to that position if nothing has significantly changed. But then I feel like it's too big a position in my portfolio. So maybe in the future I'll be more cautious about my position sizes. Maybe make the position slightly smaller, have more cash, to have more flexibility. So another thing I learned was patience. So I've had a few stocks that I bought and they kind of went down a bit, and I just kept them and kept them and kept them, and then they got acquired. I can multiply like two to three times its price. But there was a point in time where I got bored with the company and the stock, and I thought, well, I've held this for 2-3 years. I'd like to do something else. I'm glad I didn't. So it's just, if you've got a good idea, and nothing's like really changed, just be patient with your idea. Like always keep on top of it. Keep like reading your quarterly reports and thinking about it, but don't just churn your portfolio because you're bored with your positions. So those are the two things I want.
Anybody else? Yeah.
I think there's two things I want to share.
Please come here so they can also. Yeah, that's fine.
I took in a recent interview with the manager from Greenlight Capital, Einhorn. He listened to this interview with him, and he basically shared his perspective on how to approach small cap investing in an age where, in decades where indexation and like index funds take over. And he shares his view where he felt that focusing more on companies that bought back their own stock was really important, because all of a sudden in the sort of small world, the demand is just gone. So you really need to think about where is the demand of this small cap stock going to come from. So a company that acquires its own stock when you also think it's undervalued, it's actually a really good thing. So it's a small nuance, but like I do like notice that now when I evaluate companies, I look for that more. Whilst previously I wouldn't have cared, and I would have just looked at like, oh, what's the price ratio like? But now I really look for a bit more like cash flow yield, and also I want to see that they're buying back their own stock rather than just pushing out dividends just to boost that demand. So yeah, that's what I wanted to share.
Okay, great. I mean, I also like buybacks, but I like them also on the essence that they create value, not just they are supportive of. So, for example, if you think of pricing square, it's on discount, but I'm okay with it because the buybacks again, even if you cannot see it in price, they increase the intrinsic value. So both can work. Yeah. Let me just. So this is a map, let's say, of how different sectors have performed, and we see the magnificent seven, and how the technology sector has become a big part of the S&P 500. This is the S&P 500. We see an area here of energy that hasn't done well. And if we compare, this comes from Visual Capitals, they have some great, we see the opposite pictures here. We see the energy. So you see whatever goes up, then goes down, and the opposite. Unless if you have some great companies or, a tailwind, so it's not something cyclical, but you see that valuations or multiples, they just, alternate.
So what is it going to be this year?
Sorry?
What is it going to be this year?
I personally, I prefer to be agnostic, but if anyone want to make a guess, we record also the video, then we can see if it was successful. I don't know.
It's going to be 300%.
Yeah. I mean, if somebody says around, plus 10% or something, maybe they will be close to the average or something. This year I guess we talked about the AI, the tensions, some macro. I'm not a person that I like very much macro generally, but I think it was an interesting period for macro. We have like some big changes, and of course, a sad event was the death of Charlie Munger. For you, what do you think about it? Are you tired of the AI? Do you like when we discuss it? Do you believe in it, or do you get bored? You think you don't like it? And I guess some other people they might like it and discuss more about it. So let's vote. Who like more discussion on it? They find interesting. They find meaningful that we discuss about it, even if we are value investor. Let's vote. So raise your hands who are pro AI and like more discussion on AI. A few of you, yeah. And who are not so interested? They're more on the hype side. They don't. I think more are, yeah. Okay, I think slightly the yes are happy, like the yes happy. Okay. So for those, I will disappoint those who don't like AI, but NVIDIA announced their results yesterday, and they got 22 billion quarterly earnings. So they are growing really, really fast, and it seems that they are over the margins that they have. Probably they won't sustain them for long, but there is the demand for their products. This screenshot is from our site. So if you go to City Falcon, you can follow the news. And something that I watched yesterday, and I didn't sleep well because of that. I mean, it was 3 hours and a half. But it's one of the best one of the best interviews that I have seen. Especially did anyone watch it? Yeah. Do you want to say anything about it? Do you want to say anything about the video? I mean, it was a great video. I really suggest you watch it.
I mean, I can't say anything other than you should suggest it. You're right to suggest watching it. I mean, I think I'm an hour and 20 minutes into it now, and I've taken down 3 or 4 books that I want to read. In particular, I mean, I hadn't realized he made an absolute fortune in distressed, in a bankruptcy situation, kind of like a seriously distressed stock, which was something in his biography which I wasn't aware of. What I'd really say is it shows that if you have a really good, interesting person, they deserve his 3.5 hours, you know. The one that people were joking though, because he's so notoriously loquacious, people said, "How did you manage to get it down from 28-hour interview eventually?" Yeah, I think it's well worth. I think anybody in this room would be well worth watching. Certainly the first hour and a half.
Yeah, because in the second part it gets very political, so it might be controversial. And I mean, okay, it's good just to know what the person is if you want to judge him as a person, as an investor. But it becomes more political and more controversial. But the first part, he reveals very well some of the stories. So like it's really amazing, like how he talks about the background and everything. Also, again, in our site, you can go to City Falcon and you can search about specific people and you can follow news that they are around them, and you can create your watch list and you can follow them. And by the way, is anybody investing in Pershing Square? Okay, I'm also here. It's also an interesting thing to see, but we can talk another time. Probably somebody of you could present it one day here. Okay, so now we will come back about this one and any thoughts on 2024, like things that you think that they're opportunities, not necessarily prediction of what the stock market will do. But if you see opportunities, if you see things that you see ahead, if anyone wants to say just something about it, and then we can move to the presentation, to the nice companies that we have. Okay.
So yeah, on 2024, I don't know if a lot of people are familiar with the work of Ray Dalio, but I will not say that I've finished his latest book, but these big cycles and big debt cycles and the ongoing issues between the US as a top leading free market country and the rise of China is becoming more and more constant as a recurring theme over the years. And I think on 2024 that's going to still be a major part of the news, of the concern, because if you have those Chinese companies that effectively get a lot of inflow in funds and foreign money in their markets, then I mean, if some people have a better insight of what would be the impact on the Chinese currency being a more international currency and also having their stock markets growing, because I think actually now Nvidia is bigger than the Chinese stock market. I think I saw something like that going on at the moment. So yeah, I would be happy to hear people's thoughts on that topic.
I have to share some thinking I've done around China. As some of you know, I have quite a big position in Alibaba, so it's something I care a lot about and kind of follow. But something I've observed is that if any of you watched some of the speeches at Davos, you might have seen the one from the EU Commissioner basically sharing that during COVID, there was a big incentive by the European Union to switch supply chains away from China to de-risk that. But then obviously, with that supply being sourced from elsewhere, all of a sudden you have these suppliers in China that couldn't quite offset the product that they were doing before. So I think what you're seeing now is the rise of certain platforms like Temu and what's the other, like retail China. But I've seen that happen in like a number of industries from reading annual reports, and sort of what I think is going to happen in 2024, 2025 is on one hand, another thing I've learned over the past couple of weeks is that apparently if Chinese companies want to pay dividends or buy back stock that is being listed on a foreign exchange, which isn't denoted in their own currency, they're not allowed to export their own currency out of China to buy that back. So what I think is going to happen is that a lot of bigger companies are going to start acquiring US or European-based businesses in order to have foreign cash flows that they can use to return cash to investors, and also to source their own demand. I think that's really something I anticipate and see happening because it seems almost inevitable based on that shift in supply chains.
So how is Alibaba doing it then?
One thing I anticipate is someone acquiring ASOS, for instance, which is a company that is like massively like in trouble because of Shine and Temu, for instance. But like I think there's other potential ones. But I think for Alibaba, like an acquisition like that might make sense. Alibaba has a different angle, is where they have their own logistics network, global logistics network, so they're surfing that wave of a lot of other exporting businesses from China. So they might not necessarily need an acquisition to make that work because they already have foreign cash flows. But I do think like other businesses might consider that sort of thing.
Yeah, okay. But I don't question. I look at, for instance, supply chains have been switched or diversified. If there's some particularly we have news reporting some weeks ago that it's just complicated.
I'm not an expert on the subject at all, but I mean, I've seen patterns like in retail, for instance. I've seen it happen with like for instance, if you look at what was the other presentation we had last time around, Kenmare resources. So if you do some background research on that one, you'll see that the biggest supplier of, I've forgotten the mineral, is actually China, but that Europe is actually shifting away and taking more demand from them as part of that supply chain effort, shifting effort. So it goes, it's across the board. It's not just retail. As you see it in mining, you see it in other places. Another interesting one to look at is the tobacco industry, where all of a sudden pretty much all the vaping products are being sort of imported from China as well. And there's an interesting angle there where a lot of the nicotine that goes into vaping products is produced in laboratories and isn't coming from tobacco leaf anymore. So there's a lot of shifts going on, but this yeah.
Thanks.
They're fighting back.
If we have something else, because not to have some variety of things, if we have one, two more things, yeah.
So for me, 2024 is really about elections. The election of Donald Trump or Joe Biden, I think that's going to be quite contentious. I think it might be a lot more explosive than people think, if either candidate wins. And then we've got the elections here. So you've got elections in Russia, that doesn't really matter. And so I think politically there's going to be quite a lot of change this year. One thing I am concerned about, I think the United States might fragment. I think the states might I'm kind of concerned that there might be like a very light civil law in the United States. Like just like I've been reading Ray Dalio like you, and I read his books, and he's written articles on this too, and you can see like the polarization in the country, and both parties hate each other. I think that might have an impact on the demand for US stocks, because the US has always been considered, first world country is safe and stable, but I think that's just an assumption that won't necessarily hold true in the next few years. So that might decrease valuations, and then there's also the risk that the dollar is no longer the global reserve currency. So you have a shift in power from the west to the east. And then there's the war in Ukraine and how that will be settled. So it's a turbulent time, but then volatility is an opportunity. So there's a lot of potential, but I think that there might be more volatility than in the previous couple of years. That's fine, 2 cents.
Thanks, Alex. If you have something else that you think that it's important and we haven't covered, we can take one last, because it's good to move on. But if you have something really important that we haven't covered, you can share. Okay. One last question to you. This time I will change the subject, and now Warren Buffett is alone, at the top of Berkshire. So do you think that this year maybe he might quit or change his role, or he will continue a few years until he goes to a Biden phase or something? Your thoughts on that? Because I think he's or he might. And also, when you have a partner, I guess you enjoy your job. When something like this happens, probably it's something. Yeah.
I don't think he's going to quit. I think if he becomes senile, then he'll quit. But I don't think that him and Munger were actually that close at the end of their partnership. They lived in different places. They understood each other. Like, all they needed to do was nod and grunt, and they kind of got to work. So I think because he loves his job, I think he's going to stay on and until the end, until he can't do it.
As to the top, or probably stay to the board.
I think
be involved and.
Well, I mean, he's got people underneath him. I think it's Todd and probably on with the names. But I think they might start to manage more. I don't think he's retiring no leads.
Any other thoughts on this? Okay, we can move on and we can go to our first presentation. Just give me 1 minute, please.
Yeah, he's probably. So this it works. Yeah, great.
So we have So we have Ilias with us, who is a professional in sound, right?
Yeah.
So he works in the industry. So we always have better insights when we have an insider, right? So Ilias, the floor is yours. Thank you.
Thank you. Good evening, everyone. I'm very glad to do this presentation tonight. So, before we start, I would like to know if anyone is familiar with Focusrite, with Focusrite and their products, by any chance. If you can just raise your hand if you know them. So, Focusrite is a company, is a British company. They are a small cap, really. They have a valuation of about 200 million at the moment. It's in a company in the audio industry. The reason I look at this company is because I work in the audio industry, and because the UK small caps are quite cheap at the moment. So what I'm trying to find is small companies that are stable, making profit, that don't show major risk outside of being a small cap, and also that have a bit of exposure on international sales. So I started to have a look a bit at how the company got funded. It started. So Rupert Neve in our industry, in the audio industry, is a bit of a reference because he used to work at Abbey Road. He used to manufacture the first mixing console for Abbey Road. And so Focusrite as a company started in 1985 as a bespoke command for creating mixing consoles for George Martin, the manager of the Beatles. And 2 years later, then the ownership changed to Phil Dedderich, who is also the founder of Soundcraft. And so Soundcraft, they make those digital mixing console there. So he is still the major shareholder of the company. I think he still owns about 30% of the business, but as a non-executive director, so he's just providing guidance. And so Focusrite carried on, started making audio interfaces, audio products, and then in 2004 they acquired Novation, so they do MIDI keyboards and loopers and synthesizers. And they sort of carried on for a couple of years, and not much happened in the business. They just had internal growth. And the big boost in sales for Focusrite, and which is, I guess, also the reason why everyone knows them here, is when they released in 2012 this audio interface called the Scarlett. So this is the first generation of the Scarlett. The Scarlett is just it's just a sound card for your PC. So you just connect via USB, and you can plug a microphone, plug a guitar. You connect that to an audio software, and you can make your own album. So here at the top, I've put the latest generation that they released last year. So effectively, we're still talking about a small box, a small red box that takes audio in, digitalize it, put it into your PC, and then you can have fun with it and apply audio effects. So what happened between 2012 and now? The business expanded. So they went from just the Focusrite Novation division, so it might actually be a bit small, but now they have two different divisions. They have the content creation and the audio reproduction division. So roughly speaking, it's what? Mixing devices like audio effects, sound cards, and small monitors. And then the audio reproduction division is more about making big speakers. So maybe I have it here. Sorry. So yeah, this is more about like the big speakers for live stages. We're talking about stadiums and gigs. So basically, you connect through that when you need to make music for hundreds of people. So that's some of their other product that they acquired. So they acquired a lot of different companies in the recent years. They acquired Adam Audio, Sonox, Sequential, Martin Audio, and Linear Research. All of that happened between 2020 and now. So the business has been just Focusrite Innovation, and then the first acquisition was Martin Audio. So Martin Audio, they do speakers for stadiums. And then they started acquiring Adam Audio, that's just the small speakers for mixing engineers. and then an audio software manufacturer and other companies. So now they are quite a large group. So, yeah, sorry.
It's the show, you know.
So I looked also on their page and on their investor relation page, and they made again another acquisition this year after their last financial report. So this company is called TI Max Spatial. So they make processors for spatial audio for West End shows. It's actually an Eastbourne company. There are two people, and they got acquired for 3.57 million pounds. I think there's an option based on their on how much profit they make this year. Tried to dig a little bit more, found that on Company House that they have about 600k in shareholder funds, but that's all the information really I could get about this. So all the information I'm going to show you tonight doesn't include really this latest acquisition, which is just, again, box manufacturer for live shows. So the reason why I got interested into this stock as well is because there has been a big price movement since 2018. So we're like basically minus 5% return on investment over the last 5 years. And so the stock has had a massive jump in 2021. So the valuation of the company went to about 1 billion pounds. So, and what is strange that the stock crashed even if the revenue doubled since 2018. And also they've been increasing their dividend year over year consistently. I think the one in 2014 is just a special dividend that they did initially. So why is the stock so down? We're going to look a little bit at their revenue. So in their report, they have their revenue for the different division, which is actually good to know because then we can make a difference between what is organic growth and what is acquisition growth. So you can see that the Focusrite group making the red sound card that I showed you at the beginning is still the major part, doing 86 million pounds per year in revenue, whereas the other businesses are making less than 20. And also on their, what's interesting to note here is that their revenue went down slightly between 2022 and 2023, but the biggest decrease in revenue came from the rest of the world sales. So sales in North America and EMEA got, I'd say, constant, and they managed to keep the same revenue by having other acquisition from a year-to-year basis. But the rest of the world, we went from, just for the Focusrite division, we went from 18 million to 11. So there's been a big cut down. So I tried to gather also the historical data and look how I could explain this. So I looked at their gross margin, and so the thing is that their gross margin carried on going up over the years from about, I'd say, 40, just under 40%, just about 40% to now about 45%. So their gross margin is quite high, but the problem they're having is that by making acquisitions, they started increasing a lot their operating expenses. So their operating expenses didn't grow as much as their revenue, effectively. The revenue stayed constant over the last 2 years, even if they had a new acquisition. I mean, it's the first years of their acquisitions, so you could explain that by having a lot of doubled teams over the different, within a division, the same staffs and things like that. So we'll see how that goes over the year. But that also had an impact on the operating income, which has been a bit declining over the last 2-3 years. So what happened in the audio industry and especially, and also Focusrite over the last year. Why was that price jump? What is this price jump basically? What happened is that in 2020, when everyone was at home, everyone bought their cell cards. So they had a massive revenue boost thanks to lockdown. So everyone bought one of their interfaces. So their inventories went down, their sales went up, everything was perfect. And then what happened? We had a big chip shortage. So it means that overnight you would call your your audio component distributor, and the thing that you were buying for $2 last year, now you're gonna pay 50 for it, and it's gonna be delivered to you in a year. So you have to buy now at an insane price, and you will only get the product in 52 weeks. So supply chain was all over the place. It was very difficult. Also, I didn't manage to find a lot of information about their manufacturing process, but I think they manufacture everything in China, which then led to easing on chip shortages and things like that. They started to produce more and more interfaces and cards, but inflation kicked in, and now they have an inventory issue. So on the top of the supply chain, this is just a bit of an inside joke because there was on the top of the chip shortages, the main audio component factory in Japan that was doing all the high quality components that are into our industry had a fire going on for maybe 3 or 4 days, chemical fire, and so basically that also completely destroyed the audio supply chain for components. So inventory. Their inventory is a bit scary because here you have what they have in finished good as of this year, 43 million of finished good in their shelves, which is completely really high compared to their historical levels. And so I'm not sure if this is due to the latest acquisitions. Maybe they acquired a company that had a lot of inventory, but when I listened to their investor call, they are still saying that they struggle to sell their audio cards and things like that. So that's where a bit the red flag is on the stock at the moment. So what I tried to do is to look at their current ratio, but the thing is that the inventory would be included in the current ratio as an asset. So I excluded that from their current assets, and their current liabilities at the moment are higher than their total cash plus net receivable incomes if you exclude inventory. So it's a bit of a harsh cut to say that literally their inventory is down to zero, because you could admit that yes, the raw materials are still they're still worth face value. But I think if there is really something that they need to work on, it's this finished good of 43.8 million pounds that is still stored on their shelves. So the free cash flow, they had a very low free cash flow, but they've been consistently positive over the years. And same in 2020 when they started acquiring companies. In 2020, they made a lot of cash with a lot of sales of all their products, and they still had components in their inventory, so they could carry on, and answer to the supply demand from everyone at home who wants to make music at home and record it. Then 2021, this carried on a bit because really the shock, I think, on chip shortages happened around 2021, 2022. And we could say that it's a clever move. They used all that surplus cash to acquire businesses that were struggling and really had low sales during 2020 and 2021. So that explains also the big cut in free cash flow in 2022, is because they had a large amount of investing expenses. And so now their working capital is sort of back to normal, which is why now we have a free cash flow that's around 20 million per year. So really, the two things that I got from their latest report is that yes, cash flow and is going to remain at the current level, so about 20 millions per year. But they need, for the content creation division, so mostly Focusrite, they need to focus on increasing that revenue on the rest of the world, so excluding Europe and America. So for that, then I tried to come up with a fair value of the stock, see if it's worth buying at the current levels. And I took what I think is very conservative numbers. So just a yearly growth rate of 3% of the free cash flow, and then an increase of 1% of their share outstanding, because they have a small, I think their share increase is about 0.3%. But it happens mostly due to directors' options. We're still talking about small cap, so most of the revenues also comes to that. With a free cash flow ratio of 20, and then a margin of safety of 15%. So that gives me roughly 24.5 million in free cash flow by 2029. And also an increase in the share number by about 1% per year. So if I project that, then it gives me a stock that should be worth about £8 per share by 2029. And with those very conservative numbers, I get to about £4 per share for the current price. So today's price, I mean, it was actually yesterday's price, was 460 pence. So now I think it got down to 450 today. And so we're still 14% above my valuation. But to be honest, if you look at any other valuation out there and all the analysts' estimations, they are already at £8 per share. So this is a very conservative number. I think if the stock reaches 400 pence, it's definitely a strong buy for the stock. They will do, I think the quarter is going to finish at end of February. They will have a half-term report in April, I think. And I think it will be a good time also to assess if they manage to work on this inventory, and look also what they're planning to do with their latest acquisition. So yeah, that's about it for now. So thanks for listening, and please let me know if you have any questions. There's a lot of other topics that I didn't cover, so if you have questions, let's talk about it.
So always 3-4 questions. We'll go to the next presentation, and at the end we'll have more, right? Okay. So yeah.
So I'm just wondering how you got a 15% discount rate. I mean, that seems very conservative, cautious to me. What in your mind is so risky about the company?
Alex, can you please come also?
Yeah, sorry.
Slower.
So, as I was saying, I don't quite know how you got a 15% discount rate. For me, that seems a bit too cautious, unless there's something about the company that would, in your eyes, make it very risky. And I understand that you're saying there's a cash flow problem, and then there's like excess inventory, and that's a financial risk. Maybe the company's over levered. But if you were to change that 15% and it was 10%, it would be undervalued. Yeah, it would be undervalued. So I'm just wondering how you kind of built up that.
So there's a very simple answer to that. It's my capability to evaluate stocks. That's why I put 15%. I put 15% just as an extra layer of protection for my wrong estimations. That's it, really. So yes, if you put that up to 10%, the stock is definitely undervalued. So I've been very cautious about my estimations, but yes, at the current price, it's a fairly valued stock. It's actually worth a buy. And yes, it's
So basically what you're saying is like in a really bad scenario,
Yeah.
it's fairly valued. So then
yes.
all the upside is
There's a lot of maybe I should have focused a bit more on the positive.
Yeah.
But yes, there is a lot of upside potential here. So basically, if you take the worst scenario, like they go even if they acquire businesses, they stay completely flat, nothing happens, and you want still to have a 15% return on investment on a yearly basis, then a 400 pence per share price is amazing. Is that it will answer that. But yes, I think if I go to 10%, which I tried as well, I think if I go to 10%, then the stock is definitely under. I mean, the fair value is definitely under 460. Yeah.
And just another follow-up question. I was asking about, I was looking at your graphs and you had like an increase in inventory, but then revenue is also being grown.
Yeah.
So if we have like a kind of inventory divided by revenue so that it's kind of that's accounted for, so we can, because I feel like inventory has increased a lot, which is a concern, but then because revenues have increased a lot, it's natural and normal to have more inventory.
Yes.
So maybe it's not quite as bad a signal as you think. And then the other thing is I just wanted to know, like you're looking at like the current liabilities, and I was wondering if like that is trade payables or is it like a note that's expiring with the bank and then it has to be refinanced, and that might place strain on the business in cash flow.
So I didn't go through the debt because they have a very low debt. So their long-term debt, I think they just started now to have, I think about 15 million in long-term debt, which is, I think, a manageable level. And the thing is that they use this thing called RCF. So So I don't know exactly what it is. I think it's they talk about yes, basically I think they have an open credit line that they can use at will if they have issues, but they're not necessarily paying. They don't necessarily have to pay it. So I think this is also why they have a very high current liability, because yes, I think about 15 million of that is just short-term debt that they need to pay back. So really here what I try, the exercise I try to do is, let's say everything goes bad and really things don't go as planned. Is it still an undervalued stock, or is there something behind that I don't see? And yes, I think it's still worth a buy.
Any other questions? Yeah, you can comment.
Yeah.
So we don't have a long mic, table this time, so.
Yeah, I've just got a few thoughts. I'll try and be as quick as I can. So the first one is not really a question, it's more sort of it's a point. But obviously your discount rate of 15% is of course high relative to what you might use for other companies. So I think it, I guess to sort of extend onto this analysis, it might be good to sort of see a bit of a curve in terms of you plot the discount rate against obviously the cash flow. And of course, the curve's going to go down, but sort of how, it shows, I guess, an acceptable margin of safety in terms of where the, company valuation might be.
Yeah.
Because it's obviously impossible to come up with a definitive valuation and for it to be correct, because it almost 99.9% of the time will not be correct. But of course, you've just got to be close enough to obviously make a good trade. So, and then I guess my sort of second, more of a question is, with the rise in inventory, and of course we've already spoke about the increase in revenue potential effects of acquisition, so maybe this might be irrelevant, but do you think, to what extent could that be due to the extremely high demand in 2020 and 2021, where people have just got these devices and they don't need them anymore, they don't know what to do with them?
From what I heard from their investor call, and also from what I know from the industry, I think basically what happened was that everyone renewed their gears during lockdown, and now there is inflation, so people are not as keen as they were before to renew their. I mean, they have less disposable incomes, and this is still a consumer cyclical company. And now that they have access to components which they didn't have access to before, they started to create a lot of goods, also to answer their latest acquisitions. So they started to work with other companies. They want to create their products, distribute them all over the world as part of their distributor groups. I mean, through their distribution network, and it's not yet paying off. So it's still in America, it's still in Europe. With the distributors have access to it, so it's on Thomann and different websites where you can buy music gears. But no one yet is actually buying them like they were buying it before. But if you go on audio websites, the first brand you're gonna see is them, for sure. Yeah, yeah. So they have a good market penetration, that's for sure.
Finally.
Yeah, but so,
So you're obviously quite a, you work in this space and you're obviously quite a technician in this area. How do you view them in terms of, outside of all of this, in terms of their technological soundness and their products?
So I think it goes back to the products that they're making. They basically have, there are two segments, having one for home and one for professional shows, and have two lines of product, one for consumer and one for professionals. Makes sense. They start to, now when you do electronics and you diversify into speakers technology, it's better to get the expertise, so acquisition makes sense for that rather than doing it internally. And now that you're doing speakers, those are passive systems, so they're literally just box with there's no plugs on those arrays. So you need the amplifying system, and this is the device on the right. So this will literally do just a very small voltage into a high current, high voltage signal that will go through the speakers for your for Glastonbury and things like that. So they have also those sort of partnership already with a lot of gigs in the UK. And yes, so basically having the entire workflow from the production side and the artist making their song and then using their devices on live shows and have the full chain sort of makes sense, and it's definitely a good idea, I must say. Yeah.
Thanks.
one last, preferably from somewhere who hasn't talked yet. Yeah, you can come, and then at the end we can have more, right? Yes, please.
Hi, I appreciate your background in this area. What is their reputation in your opinion? So, to what extent do they have a brand? Do you think they can charge a premium compared to, say, an Asian competitor with this exactly same technical product? So, and how widespread? So, what's their brand equity, so to say?
Okay.
In your opinion?
So, so I think it depends on which product we look at. If we look at their core business, which is bringing most of the revenue, Focusrite, I think their Scarlett device is a cheap device that people are using. They're still top ranked on all the websites. Of course, if someone comes with better idea and make it cheaper and with more features into it, they will struggle. Where they have a chance to survive is because they have also the Focusrite Pro range, which is those racks that we have here. And so all of that is doing the complex side of things, which is taking analog audio, turn it into Ethernet signal, so it's audio over IP, and then you can share it anywhere you need to. So those products are used everywhere. Like, for example, the latest Super Bowl show was carried on with those devices. and a lot of international events are using Focusrite rather than other systems. So yes, I'd say this pro range, that's the information that I was also trying to get, is a distinction between the Focusrite and Focusrite Pro revenue, but I couldn't find this information. So I don't know what's the ratio between the consumer and the professional range, but I think that's also their backup. Now this box, yes, maybe they have a high margin on it, and that's how they can then resist the price. But I think they're also dropping the price at the moment because they can't get rid of it. So at the moment, they're also dropping just this. So this is supposed to cost the third generation is sold for £200 per unit, but now the third generation, I think you can find it for 150 new, just because they try to address this inventory issue. So they're already applying a discount on their inventory.
I think they have a higher grade product called Claret in addition to the Scarlet, and the Claret just had a new release, which I believe had really good reviews, and is sold at a higher price point to professional users as opposed to home users. So my impression is that that's pretty well positioned and is a leader in the market. Is that? Do you agree with that? Or?
I think it depends, because I think the biggest market for them is America, and the American market is controlled by the distributors. So it's up to the distributors to decide basically who they want to be friends with. So it's for the pro market. I don't think it's actually up to what's the best product. It's more about who's your best friends. And to be honest, I don't have any incentive on that or know anything about, well, Focusrite deals with that. But I think for a direct to consumer market, then yes, you can have more feedback on this based on what you see in the reviews from people online.
Can I I'd like to invite you to High Wycombe.
All right.
I was the only outside shareholder who bothered to attend the AGM this year. There were only employees and managers, okay? So I had a nice chat with Phil Dudridge, my CEO, etc. And it's a great information source, okay? And it's a way that someone like you who knows the industry isn't trying to ask the difficult questions to them. So otherwise, I can just share. So one concern I have is that they have a profit warning, essentially, out. So we know the interims are going to be relatively weak. They're coming up, and the second half waiting is always a warning sign that there's a profit warning coming. So I asked the question straight to the CEO. What do you expect for the second half? How bad is the second half waiting going to be? And he said normally it's 55% second half. We think it's going to be in the 60s this time. And he also importantly admitted that there was some hope built into the forecast. Okay, so I hope that's of interest to you guys. Okay, but I'm with you. I'm a shareholder, and I hope it goes well.
Yeah, thank you.
By the way, attending AGMs is a great opportunity, and some people from here know we attend AGMs, and I really, it's something that I recommend. So we can have more questions. I don't know if you want to answer something on this one. Otherwise, we can have more at the end. We have to move to the second presentation, and at the end we will have more. Yeah, sorry. Just give you 1 minute.
So what was that should I sound like? I'm working on it. Really been a thing. I really don't want to do this. But a young brand to friend, you know. I don't know this. It's a little strong. Hi. Yes, it's lots of things. Japanese, white hands.
So, are we ready? So we have Ildar Davletshin in class, who has presented a few times here. He's an insider in the industry. He also owns this blog. He runs this blog, Hidden Value Gems. I always say that I'm a fan of it, so please follow it. And something that I lately discovered is this section of books, which is like that's a treasure there. Like some PDFs, some things. I need to lose more sleep to read all this. But yeah. So the floor is yours.
Okay, thank you, Dimitri. So I was actually flattered when he said that he owns this, and I thought he pointed to the read, but no, it's the blog, only the blog. So and it is good that some of you guys are having second view. So because I'm going to be talking about oil and gas, which is super boring. So hopefully beer will make it a bit less boring. Okay, so just very quickly, where I come from in terms of my search for ideas, it's basically 5 points that I'm looking at, and these are coming from like reading, my experience, mostly experience, and I think business quality is number 1. So ideally, I want to find a product that has a long runway, is relatively unique, and it's translated into strong financials. So if the product is great, but there's no free cash flow for many years, low margin, it's not a great product, or something is not right. And then low leverage, just not to lose money. High insider ownership, I really pay attention to the 4th. And of course, valuation is more art than science, but it's also a trade-off between the product quality or the business quality and valuation. So the company I'm going to talk about is a commodity, so of course valuation matters much more than for a high quality business. Okay, so in 2 words, okay, a bit more than 2 words, but what is this company? It's VAR Energi. It's about 7.5 billion market cap stock listed in Oslo. It's majority owned by Eni, the Italian oil major, 63%, and the private equity fund owns 13%. It's focused on just on the energy. And it's producing around currently 300,000 barrels of oil equivalent. What it means, it's in terms of just the size, it's roughly how much London consumes in oil and gas per day. So it kind of feeds London roughly, just to get an idea. And a third is gas. And the important point is that all assets are in Norway, in all offshore. There are 47 fields in total, so pretty diversified, of which Equinor and Aker BP are operating quite a few. So actually, VAR is not operating most of its fields. Okay, so just the background. Essentially, it's the merger between Eni and former ExxonMobil. Some of the assets were first acquired by private equity in 2016 or 17, and then they all merged into VAR. And I think it was listed, in 2022, just 2 years ago, less than 2 years ago. And that's the shareholder structure I briefly mentioned. 1 point to make, 1.3% is owned by the oligarch, let's say, or billionaire, Norwegian billionaire who made a lot of money in shipping and actually drilling. Fredrickson, also government pension fund of Norway, owns another 1.3%. This is basically the
base in terms of reserves and production. So it's 1.2 billion barrels of oil equivalent of reserves. There is extra contingent resources. Probably I'll leave it for Q&A, the resource base, because it's quite, it can be technical. And an important point on production, so oil production has been broadly flat over the past at least 2 years, but there was a drop from 2019. A lot of it has to do with COVID and lack of maintenance work and consequent strikes. But now we are coming to the most exciting point. So, okay, there are lots of numbers, and I'm not sure how clear it is, but let me do it in simple terms. So, they were producing around 200,000 barrels a day until this year. Now they are on the trajectory to reach 400,000 barrels a day, so basically double by the end of next year. How they're going to achieve it? So there are three drivers, and maybe I skip this slide for now. So one is Neptune. So it's the asset which they acquired. It's a producing asset of around 70,000 barrels a day. They acquired it last year, and the deal closed in earlier 2024. So it's already added into production. Second is Boulder X. It's around same size. It's around 70,000 barrels at peak of production. And then there is Johan Castberg. So these are the new fields on which they were spending about $2.5 billion of capex over the past 3 years. So the top line here is the production growth. I was a bit more conservative, so I don't give them the full credit of 400,000. So a bit less. The average realized price, so they did benefit historically from forward sale of gas, so gas prices were much weaker than expected recently. But for this company, it's the volumes that they contracted a year in advance at higher prices, which helped them achieve higher realized price. But it's going to drop. So higher volumes offset by a bit lower realized price. So it's a mix here. For 2026, it's $73, which is $80 oil price. This is just an assumption. It's close to spot. So assuming flat oil price and gas price of around, I think, $10 per MBTU, or approximately, I think it's around 30 euros per megawatt. Roughly. So one more point to mention is production cost. So their production currently is more mature. So costs are relatively high, $14 per barrel of oil equivalent. It's going to drop to around, management targets 8. I assumed $9 per BOE, but the new fields are more like $5 per BOE. So the mix will drive costs down. So, and all we're getting, I'm not going to go through all the lines. So last year, profits were $670 million. It's going to go to approximately 1.7 billion, so roughly 2.5 times. And even more exciting thing is about cash flow. So it was operating cash flow is 3.4 billion. It's going to go to 4.7, and capex should drop. This is the biggest question, to how much it will drop. It was 2.5 last year. Management says it's going to be around 1.5-ish because they still want to invest in new projects. On the absolute maintenance level, it's more like $500 million. So the ability to generate free cash flow is much higher. But with all that, free cash flow should be 2.8 billion if my assumptions are, hold. And now the most exciting part is the dividends. They pay between 20 to 30% of operating cash flow in dividends. That's in their policy. So they don't, which means they don't even depend on capex. So even if they spend a lot, the dividend will not be cut because it's based on operating cash flow. So if we take 20, well, they should be able to pay 30% of operating cash flow, which should translate into 56 cents per dollar, and at the current price it's about 19%. Currently it's already 15% dividend yield. Yeah, so that's that.
Tax is so high. Why tax is so high?
Yeah, tax is high because it's Norway, because it's oil and gas. So it's 78%. Actually, here it's almost the same now for oil and gas. But there is an incentive allowance, capital investment allowance. So if you invest in new projects or especially exploration, you get all that capex offset against your profits. So in theory, they keep reinvesting, they will be paying much less. So yeah, part of the free cash flow is eaten by high effective tax rate because they will probably reduce capex. Yeah, taxes are crazy I guess. Okay, now, so these are the projects which I briefly mentioned about. The most important point is Boulder X is going to be launched at the end of 24. It was supposed to be third quarter, now they're saying fourth quarter, and it's already been delayed. So I think the risk that they delay again is very, very low. This asset is being ramped up like rapidly. It's relatively small. The second or the third most important is Johan Castberg. It's actually much more north in Barents Sea, and it's operated by Equinor. So it's they're just a passive investor. One important point to make also is the M&A activity. It's picking up. It has been quite active, and this is all the deals just in offshore, actually in North Sea primarily, and multiples people pay are around $10 per BOE.
If you come a bit here, you will be inside the frame.
Okay. Yeah. Now, and that's probably just to wrap up. I'm almost done, I think, on the dividends. So. This is as I mentioned, the dividend policy is 20 to 30% of operating cash flow. They've already paid for the past, I think, 3 years, $3.1 billion of dividends. So it's almost half of their market cap has been paid back. They paid dividends quarterly. And speaking of actually taxes, previously there is a withholding tax in Norway, which is 25%. So I think you can claim it back here because it's a tax. It's like there is a double treaty agreement between Norway and the UK. I haven't done it yet, but I hope I will be maybe at least partially. And this is the history of dividends until 24. 24 is obviously my assumption. As you can see, yeah, dividends were pretty good. Yeah, and probably that's the last point. It's the insider buying transaction. So the biggest one was the relatively new CEO who came into this role, I think 6 months ago. He is, I think, previously from Lundin Petroleum. So he bought like $1 million worth of stock at 29 Norwegian krona price. The current spot price is around 31.5. Yeah, so around low 30s, most executives were buying the shares, which I think is a very good signal. Now, yeah, maybe one more point on oil and gas. I think obviously it's notorious for destroying value. It always needs more capex. Production never stays flat, or eventually it drops, and often quite quickly. So you always need to reinvest. However, yeah, and the taxes are high. I mentioned what makes me, and I'm a former sell-side analyst who used to cover oil and gas, and I hated for most of my time this sector for those reasons on your left. But on the right, I think this is what has changed recently, is that I think we are much more likely to be in the phase of early 2000s also judging by where the tax sector is, but more important, the commodity. Because of ESG, it's very hard to sanction and new projects to push them forward. You get pushback from all sides of regulators, society, etc. There is an overall uncertainty around future demand. So how can you commit capital to long-term projects with long-term payback if you don't know what demand will be? And just the discipline, like the companies in the sector have improved dramatically in terms of prioritizing first dividend, then buyback, and then maybe some investments. In the past, they were starting the other way around. And and I think Warren Buffett is buying some of those stocks, so I think it's a good sign. I mean, it's not the only reason, of course, to buy, but it's interesting that he's buying one of the few. Generally, I think he's been a net seller.
I will fix it now. Wait, Ildar. I'll fix it now.
I think I'm not sure. Yeah,
Give me just a second. Yes, now you should be fine.
Yeah. I'm just checking. Okay, so 2 more slides. So what would be the issues? So obviously the first main one is the oil price, which I didn't put here. Because if the oil price drops or gas prices drop further, it's going to generate less cash flows and dividends. I don't think there is a way to hedge it. It's part of the thesis that you have to take. If anything, there is an upside, but with the spot, you should be able to get 15% dividend now if prices remain flat, and potentially close to 20% in 2-3 years. More importantly, I think the company doesn't have a great track record. So they've promised to launch Boulder in 2023, then they delayed it. They said, I don't remember the exact cost, but they raised it by $200-300 million. The capex, they claimed inflation, which sounds reasonable, but still. And some of the other production, if you go backwards, what they were saying and what they delivered was like, sometimes it was 5% less than what they were promising for the full year. So they don't outperform on expectations. And I think the other last point to make is so there is what the market is really, what holds back the market, why the market is not excited as excited as I am, I think is because basically there is an uncertainty over the next 2-3 years, or more importantly, the trust towards management. So if a company will all of a sudden go from less than $1 billion of free cash flow to more than $2 billion of free cash flow, will they really, pay as dividends, or will they actually start fixing old assets or going for new assets, or will the government raise tax? So, until, I guess, given the track record, the market doesn't want them to give benefit of the doubt and say, okay, in 18 months, we trust you're going to raise dividends even further. And also because of, until recently, their reserve production ratio was around 8 years. It's pretty low. So the fear was that production actually, the reserve is not efficient to sustain production. So, okay, you can have this high dividend today, but it's going to drop because of production in 2-3 years. With the recent acquisition of Neptune, the reserve to production is now 11 years, so it's a bit better. It's close to peers. But on reserves valuation, they are at around $10 because EV is actually quite high. It's 12 billion versus market cap of 7.5. So there is about 4.5 billion of top combined net debt. And so $10, it's not, so if they were trading at 5, you could say, okay, this is an acquisition target. They will be acquired because people are paying around $10 for reserves, but they are, for a strategic guy, they are not cheap enough. Yeah, and this is on leverage. So in their presentation, they only point to financial leverage, which is a bit cheeky, I would say. And also when they say net debt to EBITDA, I mean, it's also a bit useless. But I still borrowed apologies for that. But because EBITDA is more than half, like half of the EBITDA goes into taxes. So so free cash flow, for example, last year was around $800 million. And so even just financial net debt is 2.5, so it's relatively significant if oil drops a little bit materially. And there is also hybrid capital of about 750 million euros, which they don't include here. They treat it as equity, so it's like 7.5%, almost like 100-year bond, basically. And then they acquired Neptune's, so I added it's 1.2 net cash that they will give for that business. Or they gave, I think, at the end of January. So I added this cash, the cash outflow into the net debt. So that's, I think I covered. Yeah, you can find me on the internet, but I'm not gonna leave it.
A little issue with the camera. It stopped working. But the sound is okay.
So I'm not on camera now.
No, unfortunately.
Pity. Right. So you mentioned a few risks there. Now, for me, the number one risk is political, and you've touched on taxation, which is obviously related. So if I understand the UK's policy correctly, the policy is to import from Qatar because that gas is magical and it doesn't have any carbon emissions, and obviously it won't cause. Giving those guys money is not going to cause any adverse geopolitical issues. It never has done in the past, never will in the future. And they've got some exposure to the North Sea, right? But what's the Norwegian policy? Are they trying to shut down local production in favour of importing from the Middle East? Or?
No, I think for Norway, it's the really longevity of the assets. I think they are, to be honest, they are better than the UK, the way they treated their offshore reserves. I think UK was carried away a bit too much. But even though, I'm not the best expert on like Norway versus UK, but like, it's funny because in Norway, it's the highest share of electric cars actually, but it's only like, I don't know, like 5 million people, so they can afford it.
But there's free energy from hydro.
Yeah.
So it's a slightly different thing. Okay, so
but it's not. I don't think they wanna start. They wanna put pressure.
Like the taxes are already high, but they are encouraging. The way they're set up is that the more you invest, the less you're paying back to tax. So they encourage companies to pay, invest.
Okay, so have taxes gone up in the last 3 years?
There was small adjustment, but broadly the same as it was, around 78% effective. It wasn't as dramatic as in the UK.
Yeah, so stable and no retrospective tax increases.
No.
Right, yeah, so it sounds like a lot more stable political environment. And is there a risk of a change in government or pressure groups coming in and changing that situation?
Yeah, that I would feel I haven't looked, but to me it's a bit more stable. I think, I don't think there is, but I haven't checked it.
Okay, thanks. You're going to exit stage, whichever.
Maybe just thing on the taxes also. The Norway stands like a lot of resource-rich countries actually depend on their resources. So when prices go down or there is a populism in power, they actually tend to raise taxes quite fast. In Norway, they have this 1 trillion sovereign wealth fund. So there is a surplus of funds. So they don't really they don't really need oil to plug the holes in their budget. So it's more like the very, very part of the very term strategy, let's say. But so the risk of an immediate change, abrupt change in the taxes, I think is pretty low.
Next, yeah, you can come.
Thank you. As a Norwegian citizen, I'm happy to confirm that I think there's a political consensus, and has been for a long time, that they want to keep a stable environment for the oil and gas sector. With really high taxes, but not too many fiddling around with it. So the UK has done the opposite of trying to the highway robbery every few years. But anyway, my question to you is this: why do you want to own a highly leveraged company like this with Johan Castberg, I believe, being one of the key assets, being a complex spar platform in the far north, exposed to perhaps more risk than the average platform? Why don't we do the other Johan Sverdrup with extremely low marginal cost, which I believe, for example, Aker BP has a slice of, if I remember right. I might be it. So I don't know. I haven't quite. And on the numbers, what are the numbers that make you convinced? You showed a lot of numbers, but in terms of valuation, what ratio, what metric is it that makes you convinced that it's attractive?
Yeah, no, that's very good. I think Aker BP, and to be honest, I need to do a proper kind of side by side to answer your question, more comprehensive. But in case of Aker BP, it's just the dividend yield. So I'm very cheap. So these guys are paying almost 15%. Aker, I think 8, 9. Maybe they're doing buybacks, so total yield is a bit higher, but it's less. But more importantly is the growth profile. So from my experience in this sector is that once companies come to a point where they are about to launch major project after many years of investing, this is the sweet spot. So production will there will be some incremental production and free cash flow or operating cash flow, and then tax will drop. Probably eventually they will disappoint. So am I happy to own it over the next 10 years? More than Aker BP? I can't say. I think it's more complicated. But in the next 18 months, I think it's a good bet for me. So it's really the phase in their production, which is essentially, I don't know, hopefully 6-9 months before we see Bloomberg X come live.
There's something that I didn't quite get. If they are committed to, what you say, 30% of their operating cash flow into the dividend, yeah. How do they finance their new projects, and how much resource they have left? Like, what are their reserves?
Yeah, so it was mostly operating cash flow, which covered both capex and dividends. And then particularly in 2022, they were swimming sort of in cash because of extremely, I don't have it anymore, favorable macro. It's okay, yeah. So they generated, I think, like 6 billion of operating cash flow. So it was enough to invest. And but then I think last year, yeah, they did. So they paid 1.2 billion of dividends in dollar terms, and the free cash flow was just under 800 million. So this hybrid equity, which they call, but essentially it's a bond, was partially covered, I think, to pay dividends. Yeah, that's what I think maybe the market didn't like. I still feel like you go to their website, it's like 15 analysts, but I've never heard about this company until recently. Like, I don't think it's a hot. I mean, oil and gas in general is not hot at all, even now. And not to mention European oil and gas. Okay, people may be familiar with BP, Shell, but then second level or third, they don't know much. Some UK names are more known, but this name may be partially because it's controlled by BNI.
And maybe a follow-up question is, did they follow the bull run of 2022, 2021 so in energy? And how is the Norwegian crown compared to the pound evolving?
Yeah, actually, yeah, it's a good question. But they listed in 2022, so they were at the end of this bull market. So and so for them it was a high base, so they had high volumes, high earnings, and so it was always like, maybe it's part of the reason why the stock is not responding to the new free cash flows, because people are comparing it from to previous 12 months, and the new current results don't look as great. But yeah, krona actually it's funny that it's actually depreciated over the long time. Say it's like almost like British pound. It's half of its value, I think, against the dollar in 10, 15 years maybe. Recently, it's 10.5 crowns to the dollar. But I think I would bet on krona than on pound or in the long term. But again, for them it's good if it can depreciate more, which probably it won't. But if it can, it's good because their costs are a lot and they are low, Norway-based companies, and they sell for dollars.
Ilias, you can also stay up. So the questions can be for both of you now for the rest of the session, all right? So you can ask now both speakers, right?
I've got what I want to say. One other thing I want to mention is I just quickly checked the price. If for Focusrite, if we apply 10% discount rate, then the fair price for the share today would be 500 pence, so £5 per share. So higher, to where it is currently, so by about 10%. That's just clarification of that.
Maybe
I have a question about what.
Because we cannot hear you, please.
I have three questions on Focusrite. Firstly, what was your assessment on the management in terms of capital allocation, just whether you trust them? What is their market share?
Okay.
And who are their competitors and is there any risk of those markets?
Yeah. So about the management, I must say I was surprised to to see who the founder was, and I think that they have big figures of the industry, and especially the like very important British personalities in their top management. I think Tim Carroll is the current CEO. Seems to be doing a good job there. I don't see that too much as a problem. In terms of competitors, I can tell you straight away who are the competitors in the UK. So you have, but they are mostly private equities, which is why it's also a bit difficult for me to compare that with other companies. You have, the first one is Harman Audio. So Harman is now a subdivision of Samsung. So it used to be an independent group who used to own most of the American pro audio companies and some of the Swiss ones, and got sold to Samsung for making headphones and car systems. So their pro audio side isn't as big as it used to be, and a lot of the R&D staff got fired and then ended up going to companies like Focusrite and other competitors. There's a lot of things in the UK. There's also Audiotonics. It's a big one. So Audiotonics is a group of companies with where you have Digico, Allen SSL. So the Oxford mixing consoles, basically all the legacy Abbey Road mixing consoles and audio gears. It's a big group. Again, everyone's doing a lot of acquisitions at the moment. So that's the group I work for. There's also Music Tribe. So they're based in Manchester. So they own brands like Behringer, Midas. So they operate more on like producing in China, R&D in Manchester. They have a lot of their staff, which are friends of mine, to be honest, remote. So I have a lot of people working from, I know a lot of people working from them that's all based in London. So I'd say the London-based group that operates, builds in the UK is Brady Audiotonics, and and that's the one I prefer, and that's why I work for them at the moment. But yeah, it's quite incredible to see how many audio groups and major international audio groups in audio are actually based in the UK. You have some in Germany as well, but they are not as big. They are good at what they do. They do high quality, but they don't have the American markets. And that's their biggest problem. The problem for German companies is access to the American continent, both north and south. In America, you have big distributors, and those distributors hold the keys to the entire continent. So if you don't work with them, you don't distribute there, or you have to go via different routes. Focusrite is working with the same distributors as we are working with other tools. So they go through the same routes with Claire Audio, which are they hold 99% of the American market, both in America, in USA and Canada, and in Mexico and in Argentina, everywhere. The entire American continent is all about Claire Audio and maybe 2 other distributors. So the penetration to this American market, which is the one that is, as we saw, makes most of the revenue. If you don't have those, that's what I was trying to say before. If you don't have those friends, you don't get access to that. So then the remaining market that you have is European or rest of the world. And as we saw, the rest of the world can fluctuate on a year-to-year basis, and Europe tends to be stable, but tends to follow whatever the Americans are doing in terms of compatibility, getting the bands from America to operate in the same gears when they come to Europe. So that's why it gets a bit difficult. I hope that answers your question. Yeah.
I just want to ask if Claire is a public company, distributor.
I don't think so. No. It's not. No. Yeah. It's a very good business. But yes, that's the thing I see. There's a lot of private equity. Even a lot of there's a few companies in the audio industry and the video industry as well that used to be public companies that went private. So the thing that I see really in this industry at the moment is a lot of consolidation. People are buying each other. There's a lot of external growth happening in groups. So someone came into the private equity business, started to inject money into those groups and try to basically create growth and start to consolidate business units and things like that. But yeah, I don't see that many audio or video companies that are publicly traded, unfortunately. If you know some, please let me know. Well, except maybe whether we have Dolby, maybe that's another public company. I think that's many others. Yeah. More question? Yeah, sure.
Do you have an intuition about the direction of the market, and do those recent acquisitions align with any sort of intuition that they seem random?
For Focusrite specifically, I don't think they are. I think what they're trying to do is I think that their board is the board of directors is competent, which is a good thing. I think what they're trying to do really is to de-risk their principal business unit, which is Focusrite, and Focusrite that relies on a single distributor in America, which is Claire, and they try to see how they can generate revenue in other business units and basically de-risk a bit that basically it's one product with one distributor. If that link goes down, 50% of the revenue is gone. And I think that's what from my understanding, I think that's what they're trying to address. Owning, when you have companies doing acquisitions, if it's something that they're not used to do, like you do social networks and then you do metaverse, then it can go a bit badly. But if you're an audio company and you get a speaker company and you get audio amplifiers and things like that, those businesses can then work together and then they can develop an ecosystem over the years that will provide to end users a complete solution that they can just say, I need to do this, I need to do a show, and I provide you a mixing console, I provide you speakers, I provide you amplifiers, you have everything you need, the microphones, everything's coming from us, and you have the big package in one go. So I think that's the approach they're trying to do by developing and also building skills in in fields where you when you make sound gears you don't have necessarily competence. It's not because you're making sound cards that you know how to make a speaker. And so that's where, as I was saying before, external acquisition sort of makes sense because you're getting that expertise within your.
Also, some questions to Ildar as well.
Wayne, do you wanna?
So, I'd like you to touch on the valuation. Given the context of the regulatory environment, DSG, etc., VAR Energi, you specifically mentioned that you can very stably that maybe forecast out for an 18-month period. Could you touch on a possible exit price for, because as an example, this is for VAR Energi, if I were to invest in a short-term period?
Yeah, so I mean, the way I would look at it is just see where other established players are trading at. So I think on the dividend yield you have a range from now maybe like 3-4% for the US. They like say Exxon or Chevron, but they also do tons of buyback. So I think it has to be added. So that would still be around high single digit, maybe 7-8%. And then the Europeans would be in the high or low teens probably to get like the dividend yield plus the buyback. So this company, if they can convince the market that their production is not gonna drop after 2026, because that's I think what essentially the market is concerned, or the capex is not gonna double or stay at high level, I think they can go all the way to 12 or 10%. So that will be roughly like a 30% uplift plus 15% dividend yield in a year. So I personally think, I think it could trade at around 4. So right now it's 32, so like over 40, and the dividend.
And do you see it as a long-term investment?
Well, I'm happy to, as long as I'm happy to hold it as long as they pay this dividend and I'm comfortable with the profile in terms of production and capex. The problem is that what was the major issue in 2010 until 2019 for the sector is that oil price was going up, it first went up, then it dropped, but capex went so much faster, and in the meantime, shale all of a sudden started working. No one believed it until like maybe mid 2010 to 2014, and that's when oil went all the way to 20 in 2016. So I think now it's I'm comfortable with the sector. So and I'd like to get exposure. So there's one.
On the new CEO.
Just try to be loud, or you can.
Sorry, just a very quick question on the new CEO. Whether what your impression is?
Well, I think he's got a good track record, and I think the fact that he bought $1 million worth of shares is also a good sign. So I think I'm positive. I don't think he's a superstar sort of status, but I can live with him in the sense that I'm not too worried about him. Okay, one more.
Just a quick question on, you say that he acquired shares from it. Do you know any thoughts on the open market was that he wanted to?
Yeah, so basically it was during the placement of shares by the one of the private equity groups. So they were selling their final bid. It was, I think, in September last year. So there was a set price of 29. So there was like brokers run the process, so they can put an offer if you have access to those brokers. It's harder for retail people. So the price. Then in the morning they announced that they sold this at 29. That day the price was like 29 and a half. I actually bought as well. I saw him buying at 29, and then but I bought it like just under 30, like 29 and a half or something. Yeah.
So okay, we can take 1, 2 more, and then we can go offline and we can mingle and talk. Right? Do you like this one? Shall we also socialize and yeah? Okay, so we can take 1, 2 more. Yeah.
Sure.
Yeah.
Oh, I have questions for both of us. Start with you. I have literally zero experience.
You can
with
use
it.
the microphone. Since you're very close.
So I have zero experience with investing in the energy industry apart from during lockdown when it went negative, and it seemed pretty obvious. You like presented your valuation. What I'm trying to understand is your process with what drew you to this particular company. Something I saw in your presentation was, for instance, the measure EV over their reserves. Are there any other, like, it's a question that came up already, but I'm trying to understand, like, what drew you to this particular company and the way you sort of valued it. I had a couple of attempts at making valuations of oil company, absolute disaster. But I pretty much saw you sort of projecting 3-4 years in the future, probably using the sort of futures and that sort of thing. If you could just sort of walk me through that, out of curiosity.
Yes. So basically, it's the way I try. I don't do DCFs for those companies primarily because, like, so you either do it very simple or super complex, and I think the result will be similar, because if you do it super complex in a super complex way, you need to know the production profile of the key of all the fields they have, and normally there are 3 stages of production. So you have like a ramp up, which could be 3 years, a plateau, depending how far they go in the ramp up. It could be 1 or 2 years of a plateau, or maybe 5-7 years. Also, offshore field, they have much bigger pressure because there is water on top, so they produce more per well, but they run faster down. And then there is this decline, and then the tail. So like the old donkey wells, as they call them in Texas, they can be producing almost 100 years in theory at a very low rate, but of course it's a very high energy intensity because you use the electric pump, and that consumes a lot of energy, but also there's a lot of water, which is like almost 98%. So anyway, it's a long answer, but I can say that because I used to model it, and my conclusion is that it's useless because you model all the way, and then nothing, you don't live, or we don't live that long. But the point is also, of course, management normally lies, or maybe they're optimistic, or I don't know, but I don't have good track record with management in the resource space, because mostly they need capital. So they lack actually in the VC, so they will tell you about the fantastic stuff. But so what I now do is I look at the kind of current status. I try to adjust for the oil price, so I try to work out the assumptions. So what if the oil price is 60 or 100? And with this company, it's pretty easy. And then I try to see where production will be in 2-3 years. So are they at the peak of production? Because the problem with BP and Shell, they're not growing. Okay, they may be talking 1, 2, 5%, but it's like 5% today, next year, then -5% the year after. It's flat production. But costs continue to rise. They're going into worse over time if you do nothing, because you have much more water inside the reservoir. You will be facing much higher costs. So per barrel, you are squeezed. So if you have flat production, So what they do then is they do M&A and or buybacks, whatever, in financial engineering. But it's like a bond and maybe a bit better than a bond to me. So I'm not interested in BP, Shell, even Exxon, although it's a high quality. But then with small names, really, yeah, you need to trust because it's much higher risk. But this seems to be in a good kind of space because it's not micro, which has one asset. It actually has 4 to 7. It has a track record. A lot of these assets were producing since the 70s. And it's not the best in terms of like track record, but it's solid. There is free cash flow and relative size. So yeah, and so basically, and I think I mentioned in another question, it's if the company is at peak capex and is about to launch major project, I think it's a good period to be invested. So, and I will sell once the stock starts pricing in higher dividends in the future. I'll probably sell. Like I don't want to stay in an oil and gas for 7% with no growth yield. So that's how I look. But then I have the numbers, these long numbers, to back up to be confident that this yield comes from the real, not like one-off sale of asset or under investment. Yeah, that's kind of.
It makes a lot of sense.
And reserves to production, it should be around 10. So if it's less than 10, so you look at 2P, proved and probable, and divide them by the annual production. So if it's over 10, it's pretty good. If it's less than 10, it's in trouble. So they will most likely fall, production will fall, or they have to ramp up capex. They can't have low capex and reserves to production of like 7. It's bullshit.
I find it makes a lot more sense looking at it that way, where you were sort of focusing on those expansion projects.
Yeah.
Thanks.
Do you have another?
Yeah, I do. I think I had a quick look at Focusrite. I'm not an investor or anything. Have some familiarity with brands, etc. What I saw in my sort of very rough analysis is that they clearly have a high return on invested capital. So they sort of they have to create a lot of value. But the sort of thing which I missed from the presentation was trying to understand where that comes from, and sort of the link with these acquisitions, where you were saying like, yeah, there's a lot of acquisitions happening in the sector. But what I was trying to understand was, you already talked about that they're trying to diversify away from the sort of consumer products. I'm trying to understand, does that actually add to their sort of return on invested capital as well? And in particular, perhaps, there's 2 things that stood out for me when I looked at the company. Was that if you looked at operating margins were actually very stable over time.
Yes, that's what.
Which I liked, sort of what you want in an investor, right? But then, what I also noticed is that over a 10-year period, their return on equity actually went down. So I can't quite explain whether they're sort of hoarding cash, or which I doubt, because there wasn't really a lot of. They're very asset light, they don't have a sort of tangible sort of margin or anything or buffer.
Yeah.
So I'm trying to understand, is what management is doing right now, does it rationally make sense? You already talked about, oh yeah, they've been in the industry for years, they know what they're doing, but something I sort of missed in the presentation was like this professional segment. What are the operating margins for those, and what are the operating margins for the sort of consumer segment?
I know.
That was the sort of missing link for me. So, any insights on that?
It's missing for me as well, because those information are not public.
Good.
The thing is that I tried to get those information from the annual reports, from the previous annual reports, to make extrapolations to what is happening now. I tried to have a look at the different annual meetings to see if I can get grasps of some information about it. But I didn't get that. What I was trying to show with this presentation today was very conservative numbers. Maybe I should have emphasized on this a little bit more. What I was trying to do is let because the stock went down a lot. So let's say things go really, really south, and you know you see such a low price at the moment. You're like, is it a good opportunity, or am I missing something? So what I was trying to do is to actually understand if really things go bad, is it still worth a buy? That's what I was planning to get to. And even if you take the lowest assumptions, even if you took a very small free cash flow growth, no buybacks and things like that, we are still close to a buy. And so even if you reduce the free cash flow, the price of free cash flow and things like that, it's still close to a good price. Now, on what the management is doing, and does that make sense, etc. That's the problem. They don't. So the first thing to say is that it's an AIM company, listed company. It's not an NSE listed company. So they can put. There's less restrictions on what they have to put on their annual reports. Their annual reports is more for communication than it is for regulatory purposes. So even if you try to get information from their division incomes, part of the world's incomes and things like that, the only information you get is what's happening on the annual report and the half-year report. That's the two information you have to actually understand what's going on. So yeah,
So sure. I think we can continue the conversation. So we had an issue with the camera of the laptop, so we had to switch to a phone. So it was great, the whole discussion and your participation. Thank you really for creating all this atmosphere, and the speakers again.